If you know the seller before you write the sales contract, they call that an identity of interest, meaning that there's a relationship, whether it's business or personal, we don't know. But if you... Now that you know a little bit about FHA loans, let's talk a little bit more specifically in detail about some of the things you should know to save that deal or help that loan get across the finish line. 10 things every buyer should know in order to save their FHA loan. Refinances. A lot of people talk about, hey, when can I refinance my house? Well, in order to use the appraised value on a refinance, FHA wants you to be the vested owner for 12 months. So essentially you need to own the property for a year before you can use the equity from the appraisal in order to refinance. So if you try to refinance any sooner than then, you're not going to be able to use the appraised value. They're going to force you to use the price that you pay for it, and that's called an acquisition cost. Sales agreement. I see this a lot of people when they want to buy the house they've been living in, they move into it and then write the sales contract. You got to remember, FHA cares about who the seller is and what the seller's relationship is to you. So if you know the seller before you write the sales contract, they call that an identity of interest, meaning that there's a relationship, whether it's business or personal, we don't know. But if you sign a contract on a property that you've already been living in and you haven't been living in that property, renting it for 6 months, you're not going to be able to put 3.5% down. You're going to have to put 15% down because FHA considers that transaction to be a non-arm's length transaction, meaning you are closer than an arm's length from you to the seller, and they call that an identity of interest. So the key is, if you know that you have something to work on, I got to work on my credit, I got to, get a job, I got to save some money, there's some things that you know are going to take time, write the sales contract to purchase the house first. That way you have a business relationship, meaning I'm buying the house from the seller, and then write a temporary lease agreement behind it that allows you to move into the asset and rent the property from the seller for however long you need to rent it for before you can purchase the home. And then that way you don't have an identity of interest and you can still use the 3.5% option to purchase that property. 3 to 4 unit property transactions. So this is multi-unit. So 1 unit and 2 unit properties, this rule doesn't apply for. This is specifically for triplexes and quadplexes. When you try to buy a multifamily property and you live in one of the units, that's a great house hack, right? It's a great way to build equity, build your real estate portfolio, live in one of the units and rent the other 3 out. That's perfect. Let's say you're buying a $500,000 4-unit property and you're going to live in one of the units and rent out the other 3. FHA has what's called a self-sufficiency test, meaning that the property needs to be able to pay for itself, right? In the event that you're not able to make the mortgage, you're going to live in one of the units and you're going to rent the other 3 out. Well, what is the fair market rent on those other 3? Well, rent is $1,000 per unit. Okay, so you got $3,000 coming in. Your mortgage payment's $45,000, so you're only paying $1,500. That sounds like a pretty sweet deal. Problem is, FHA wants to know what the rent is, including the one that you're living in. And so if it's $1,000 for all of the units, the property only performs at $4,000. The mortgage's payment is $4,500. That doesn't sustain itself. You don't pass the self-sufficiency test. You don't get the home loan. And I've seen many deals die because of that. So you'll have to put more money down, or you need to find a property that's going to be able to pay for itself. And that's called the self-sufficiency test for FHA. Another cool thing, non-occupant co-borrower. So FHA allows people to help you qualify to finance the house, but they have to be a blood relative or a relative by marriage, and that other person that you bring onto the loan with you, they need to have a credit score. So that non-occupant co-borrower, if they don't have a credit score, they're not going to be able to help you. So just be careful when you're trying to add additional people to the loan. Make sure that the credit standards for that other person are going to be eligible and they're not a no-score co-borrower. A great thing about FHA is the seasoning periods and the exceptions to derogatory credit. So bankruptcies, foreclosures, think of those like that. Foreclosures is going to be 3 years, for extenuating circumstances, it could be 2. So you don't have to sit on the sidelines for as long as other programs. In the event that you lost a house in the past, the seasoning periods are shorter. Another great thing is gift funds. Gift funds are really easy to source on an FHA loan because it could be from a blood relative, a relative by marriage, it could be from a family friend, it could be from a fiance. The way that we verify the gift funds, it's a letter that says, hey, I'm the donor, I'm giving the money to this person. It's a gift, they don't have to repay it. And then we document the transfer via a wire from the donor's bank account directly to the title company. So we don't get into the donor's funds, where they got it from, how they got it. It's just who sent it, where did they send it from, and then the letter documents that same relationship. You sign it, donor signs it, the borrower signs it, and we can use those funds to help you with your down payment to purchase your home. One cool thing about income with FHA is child support. alimony. Sometimes things don't work out as we plan, and there's been a marriage that gets dissolved, or there's a baby that needs child support, and so there's a court order that gets put in place where this other person has to pay money. All you need is 3 on-time payments in order for us to count it. If you're waiting for an event to happen, as soon as the court order happens, we have to have 3 on-time payments, and you can't make all 3 payments at once. They've got to literally be made like this month, and this month, because remember, FHA is looking for stable, predictable, likely to continue income. But that's a pretty short period of documenting income for something that just started, so 3 months is pretty cool. One good thing about FHA is they do allow you to use rental income, but it's probably not what you think. So rental income from a property that you currently own, it is allowed for FHA, because remember, FHA is a first-time home buyer loan, and I see this get caught a lot of time. You're in a city now, you have a house, right? It's a conventional loan you got, and you want to go buy another house, and you want or need to use FHA financing. Do not be thinking you can use the rental income from your vacating primary to purchase that next house with an FHA loan if it's in the same community. So FHA's got some pretty strict requirements around the use of rental income from your current house that you're about to vacate. You got to be relocating more than 100 miles away, right? So you got to be moving. You got to have a 25% equity position in the current house that you're leaving. You got to get the lease agreement. It's a 1-year lease agreement. And you got to get proof of receipt, right? Meaning I got to get the security deposit and the first month's rent, and that gets deposited in your borrower's bank account. So I've seen lots of loans get hung up because the lender's using rental income from a vacating property in the same city. It's a no-go. FHA will never allow you to use the benefit of rental income for a first-time home buyer loan, because you're supposed to not own a home on an FHA loan because it's designed for first-time home buyers. You're choosing to buy another home. That's why they're not going to let you use the rental income from it. Mandatory downgrade. So credit, even though it's super flexible, disputed accounts can be a problem. So FHA has 2 types of approval, right? Electronically approved through Total Scorecard, or referred, and it's a manually underwritten loan. There's a few things that can cause your file to be manually underwritten. So disputed accounts on your credit report, if the balance is more than $1,000 and it's a derogatory account, that will cause a manual downgrade. If you are self-employed and your current year's income is more than 20% less than your previous year, that will cause a manual downgrade. If you've got mortgages that are not on the credit report, that have not been paid on time, when we get a supplement, that will cause a manual downgrade and possibly a denial. And then another one is your credit data. Sometimes you don't have enough bureaus with enough data on you pulling through the algorithm, and that could be insufficient credit. That could cause a manual downgrade. So manual downgrades are not bad, but when you have a loan that's being stretched, or a loan that's on the outsides of being approved or really close to not qualifying, those loans will get caught and they'll turn into denial. So be real careful about manually downgrading a home loan. So those are some of the great things about FHA and some of the things that you should be aware of. Kind of technical, right? But it's still something you should know. Save this, share this. These are great things to be looking out for if you hear about anybody or you're choosing an FHA home loan.